Corporate Finance Presentation, Risk and Discount Rates. Get ready, it's time to take your chance with Corporate Finance. We're continuing to talk about risk as it relates to capital budgeting, investment type of decisions, those investment type of decisions that typically will involve a large outflow up front and then an impact of inflows multiple years into the future. Two components to the decisions, major two categories that help us for the thought process, that being what's our expected return for the capital project and then the level of risk. Now, we focused a lot on once we know the expected return using our present value tools, that being the net present value and the internal rate of return calculations, to then figure out and think about one project versus another or whether or not a project would be worth taking on. For more information about that, take a look at a prior section. We're now thinking about the risk component and putting that into practice. How can we apply the risk component? So we've looked at some statistical data now. We've looked at the idea of applying statistical concepts to get an idea about the risk from one project to another. And again, for practice with that, the best way to understand these problems is to run through example problems. We do have many example problems, but now the question is, once I know what the risk is, what do I do with that with regards to my calculation process? How do I fit it in to my decision process? In other words, if I know one project has a higher risk than the other and I can only basically pick up one project versus the other, how do I take that risk into consideration with my assessment when my normal tools for a capital project are the net present value calculation and the internal rate of return? So different capital projects will need different discount rates if they have different risk levels. So answer being, we can change the discount rates. We can adjust the discount rates as the risk levels will change. So if we have two projects that are going to be in place, then one project we determine to be more risky than the other project. When we apply our net present value calculation and the internal rate of return, we might then adjust or increase the discount rate for the project that includes more risk within it. So if the risk level is average, the standard cost of capital discount rate is used. So if we have an average project, it's an average amount of risk, a standard amount of risk, we might calculate our weighted average cost of capital, use our standard cost of capital discount rate as our normal required rate of return, that in essence being the floor discount rate, the discount rate that we would have to clear, the discount rate at which, if we calculated the net present value would have to be over zero in order for us to accept the project, as we discussed in prior sections, given the fact that we would then have cleared that discount rate. If the risk is above average, the discount rate used will be higher than the cost of capital. So if we're then looking at a project that has a discount that has a risk level higher than the normal risk level, then we're going to compensate with that by then increasing the discount rate. And if that discount rate is basically our hurdle rate for that particular project, then we'd need the project to clear that discount rate in order for us to basically accept the project, and we can use that for our comparison purposes. So the risk level is generally measured by the coefficient of variation. So remember what we talked about that last presentation in our kind of statistical concepts. The best way to get an idea about this spread of data is to do practice problems. We will work many practice problems. So risk related to long-term project, the longer the project, the more difficult the forecasting. Obviously, when you're looking further out into the future, there's a whole lot more uncertainty and unknowns than if we look shorter into the future. To compensate for that, we could increase discount rates used for late cash flows due to increased uncertainty. So one method you might put into place is you could get a little bit more complex on a capital budgeting project. We've seen these capital budgeting projects that could get quite complex with regards to the cash flows that might happen in the future. We might do an entire budgeting analysis to determine what the cash flows would be. We might have different cash flows from year to year in the future, which we can then present value with the use of our net present value calculations. But we also might say, hey, the risk is different from year to year. Year one might have less risk than year two, and so on. So we could apply then different discount rates applied to different years. And you can imagine how when using the net present value calculation, we can basically use different discount rates for the returns. And that's another method that might be applied. So you might see tables something like this then when you're calculating your risk and you're then trying to apply that to a capital project. You might say, well, if the risk is low, then we're going to use the 5%. Maybe that's our cost of capital. Maybe that's the floor risk that we would need to clear normally. Moderate, 7%, average, the 9% above average, and then high risk, 15%, very high at the 18%. So now we're saying, hey, look, if you got a project that's pretty low on the risk level and we have the money to put into that project, then we want to clear the 5%, possibly that being the cost of capital. If, on the other hand, you have a high project with a high amount of risk, we might say, hey, look, that, the expected return is good on that. We like the expected return, or possibly, but we want to do our calculation based on the fact that there's a whole lot more risk. And so if we did applied our net present value types of calculation, given the higher risk levels, then they would have to clear, a higher threshold for that net present value calculation in order for it to be acceptable. So you can see how we can then take the risk that we would calculate and then say, okay, well, how do I put this into comparison in practice so I can compare and make decisions on whether to take a capital budgeting project or compare different capital budgeting projects. One way we might see that applied is to adjust the discount rates as we apply them to the capital budgeting process and the calculations of the net present value of them.